Good afternoon. Well, today's stock market rocked a few places, a few people, I'm sure. The market closed down 264 points, and that's after being down at the end of last week a couple of hundred. So people are wondering why. People are nervous about how far does this go. We don't have any definitive answers, but we have some ideas that hopefully will help you. We think the main culprit, the reason why the market's down, is a strong dollar. The U.S. dollar has finally spiked and moved upward. We had expected this to happen gradually over the last 6 months. It has been part of our thesis that stocks are undersupplied and demand will be coming in from overseas, as well as changing attitudes here in the U.S., and everybody's going to want to buy those Dow Jones blue chips. Well, the market spike is creating a problem for the market in certain sectors. Those companies that are in production of commodities, metals, coppers, aluminum, steels, gold, they're having problems with a strong dollar, because what happens is the price of the commodity at the end of the production comes to market, and since all these commodities are priced in dollars, it takes fewer dollars to sell on a global basis, and so the earnings of these companies now become suspect. Another sector of the market that really gets hurt with this is the multinationals, the IBMs, the Procter & Gamble's, Minnesota Mining's, Coca-Cola. They have so much of their earnings coming from overseas that the sales overseas, when translated back in a strong dollar environment, end up being fewer dollars, require fewer dollars to satisfy the transaction, and fewer dollars means fewer profits for these companies. So the market is in a bit of a shock mode because of the rapidity that this dollar move has had, and that we think is a real culprit. You add to that the questions about the economy in general across the globe. Europe is very, very fragile and appears to be going into a recessionary sort of a phase, as is China. But we all know about China. You can't really get the real scoop there. But China appears to be weak, and we know Japan's stretching to do what it can to get away from deflation. So the global economy is scaring people, and our thesis has been, as you recall over the last 2 years, that a lot of those Americans, $16 trillion worth of investments, may want to come home because those investments don't do well overseas if the dollar's strong. So we think there's more strength coming, and as a result of this, we would not be surprised to see some more volatility in the market. But a strong dollar is good. A strong dollar is really good. Lastly, you've got the geopolitical tensions. You've got ISIS running around disturbing the Middle East. You've got Putin running around disturbing Eastern Europe. Weather's getting cool. Putin controls all the natural gas for Europe to keep it warm. You know, what's in store? It's kind of a frightening experience for investors overseas. So the U.S. looks relatively safe and calm. And yet we have our election coming. And to our way of thinking, this weakness right now is temporary. It's an adjustment to the currency. What are we going to do about it? We're going to scrub up our portfolios, your portfolio, and make sure we don't have too much exposure in companies that are vulnerable to a strong dollar, meaning their earnings go down. We don't have many of these, but we still are probably going to scrub some more. You know, preservation is still key for us. Other than that, we think this is something you got to sit through, and our concerns will focus on the election. The election could be a fulcrum. It could be the point at which things do change, but we won't know any of that until after the election. So hang on, don't go away. I think this is a short-term blip, and it's largely caused by a strong dollar, which is good. Take care.